I didn't get paid yesterday due to this news. I had an emergency fund, so it was all good. But I wonder if that's one of the reasons this news came out so quickly because employers had to tell their employees what happened. We'll get into that and how it impacts the housing market in a second, but let's start at the beginning. Like, what caused this downfall? So, SVP, they bought a bunch of treasury bonds when rates were historically low. And so remember 2020, 21, the Fed lowered rates due to COVID and the cost to borrow money was like 0.25%. Right now, it's about 5% for lenders and banks to borrow money. They pass on those rates to you. That's why rates are in like the 6 and 7s when it comes to mortgages. But somehow they never foresaw a scenario where rates are going to go up. And here's the thing about rates going up. When rates go up, it makes it riskier for folks to lend money. SVP, they deal with a lot of tech startups in the Silicon Valley area. And so with these tech startups, they burn through a lot of cash and they need a lot of outside investors to keep things running. Most tech startups fail because they have to burn through a lot of money in order to reach profitability, and some never reach profitability, or investors lose confidence before they reach profitability. As a result, it was harder for these tech startups to raise money from investors. As a result, they had to pull money out of the bank to meet basic liquidity requirements such as payroll, inventory, etc. So the bank itself experienced unforeseen somehow liquidity issues and became less solvent, not insolvent though. As a result, they were like, okay, we need to sell some of our portfolio. So let's go back to these treasury bonds. When they bought them, the rates were very low. And of course, the rates have gone up. And so they were getting like a return of 1.79% on those bonds. The market rate right now is about 3.9%. So like, okay, let's sell this asset because it's underperforming and looks bad to our investors. However, selling the asset and taking a $1.8 billion loss also looked very bad to the investors. And therefore, it was hard for them, ironically, to raise capital as well. So they had to sell stock. And so when they sell stock to raise money, it let the outside world know that there was issues going on within the company. And then once like Friday came around and stuff like payroll and more news came out, it became a run on the bank. And so a run on the bank is literally what it sounds like. Folks run, or I guess they can drive to the bank in order to pull their money out before the bank goes to zero and goes broke. Ironically, the run on the bank is what causes the banks to go broke because, like, it's all about confidence. The US dollar is backed by, missiles, not gold. So the market is all about confidence. Like the top four banks, so Wells Fargo, Chase, JP Morgan, and Bank of America, they lost $55 billion in like equity over the course of like the last 2 days. Here's the thing though. Big banks like those can weather the storm. It's really the smaller regional banks that may take an L and experience some of the drama from this trickle-down effect. And so you just watched a video where somebody like me talks about it, right? So you're like, okay, I'm at a smaller regional bank, so now I may need to take my money out. And it's all about confidence, the consumer confidence in the bank, and folks end up taking the money out of the bank. They become less solvent, can't make loans, and then the US government needs to run in there and save the day, just like they saved the day during COVID by raising rates, even though the Federal Reserve technically raised rates and not the US government, but they kind of move hand in hand. Now let's talk about how this may impact the housing market. A finance guru by the name of Larry McDonald is predicting that the Federal Reserve may have to lower the cost of borrowed money by 100 basis points because essentially he's saying they caused the bank run by raising interest rates, which of course does take away all the responsibility from the banks and their ability to assess their own risk. Like SVP honestly didn't need to sell that stuff. They were just looking bad in front of their investors. But here's a quote from him. Within the next couple of months, as the contagion brews up the channel up to the high yield leverage loans across the entire ecosystem, that's when the Fed's going to have to bring out that other fire hose and cut rates probably within the next 6 to 9 months. And so that part does make sense because once again, folks are reluctant to spend money when the cost to borrow money is high. And so they're like, okay, now's the time to save. And so one thing that folks spend a lot of money on are homes. And as we know, the housing market is kind of dampened down because rates are so high. However, the housing market has not failed because folks that have homes don't want to sell their homes because they're locked into a low rate. So it's caused, once again, this log jam in the market. And so one way to save things may be to lower the cost of borrowing money so folks can buy homes. And so investors can lend money to businesses so that they can keep the good times rolling. This, of course, is counter to everything we've heard the Federal Reserve put out so far. But of course, they, I guess, couldn't have seen this coming. And so all the guidance we got from them was that they're going to raise rates throughout the course of the year at smaller numbers and maybe at some point tamper out, but at no point lower rates in 2023. But of course, this is a huge change. So it does make sense that they may potentially lower rates towards the end of the year. But let's not forget, home prices still have yet to go down, and they were never going to go down to pre-COVID levels. But now, most likely, if interest rates are going down, they're not going to go down even to probably 2021 levels. If we look at what the average price of a home in Q1 2020, it was $383,000. In Q4 of 2022, the most recent data, home prices were about $535,800. In Q1 of 2021, they were $418,000. Like, home prices just go up, up, and up no matter what. Folks can't predict the future, but I can predict that folks will always need a place to live. That's why real estate is such a solid asset if you plan to hold the property. So if you want to buy a property where the rates are high or low, I'm a realtor here in Dallas. I love to help you. I can help you in all 50 states with my national real estate network as well. But buy land, rumor has it, they're not making any more of it.